Monday morning, 9:30 a.m. Eastern. The opening bell rings. And in the next 11 minutes, the U.S. market is going to attempt something it hasn't had the chance to do in 48 hours. It's going to try to process reality. 2 full days of oil price movement, bond market repricing, geopolitical developments, and institutional repositioning, all of it sitting in a queue, waiting for execution. And when that queue finally opens, it doesn't release slowly, it doesn't trickle out. It hits the market all at once, like water through a dam that just cracked. That is what a compression event looks like. And the last 3 times this specific setup occurred, the S&P 500 moved more than 3% before noon. This video is about what built up while you weren't watching, and why Monday is not just another trading day. Before we get into the mechanics, I want to give you something most financial coverage refuses to give you. Not just the what, the why, because if you only understand what is happening, you will keep reacting to headlines. But if you understand why it is happening, you start seeing the pattern before it completes. And in markets, seeing the pattern early is the only real edge that actually matters. So let's build this from the ground up. Friday, U.S. equity markets were closed. The New York Stock Exchange was dark. NASDAQ was offline. Bond markets ran on skeleton hours. But here is what did not close. Oil markets kept trading. Currency markets kept moving. Geopolitical developments kept unfolding across multiple continents. And the algorithms, the hedge funds, the pension systems, and the sovereign wealth funds that collectively control the majority of capital in global markets kept processing every single piece of incoming data. They ran their models, they recalculated their exposures, they updated their risk parameters, they made decisions. The only thing they could not do was execute. And that gap between decision and execution is exactly where pressure builds. Because in modern markets, price discovery is not a once-a-day event. It is continuous. It is real-time. It is the result of millions of transactions every hour, each one incorporating new information into price. When that process is interrupted, the system does not stabilize and wait patiently. It stores pressure. Then it releases all of it the moment the window reopens. That window opens Monday at 9:30 a.m. Eastern. Now let me show you exactly what accumulated during that 48-hour window. Because this is not abstract. There are 3 specific forces that have been building, and each one individually would be worth paying attention to. Together, they create something different. The first force is oil. Brent crude closed the previous session above $110 per barrel. If that number doesn't immediately alarm you, let me give you some context that will. In 2008, oil spiked above $140 before the financial crisis hit. In 2011, it moved above $120 during the European debt crisis. In both cases, the sequence was the same. Energy prices surged, corporate margins got compressed, consumer spending contracted, and economic growth rolled over. The mechanism is not complicated. It is math. The United States consumes roughly 20 million barrels of oil every single day. Every $10 increase in oil prices translates into approximately $200 billion in additional annual costs spread across the entire economy. $200 billion. That is not a Wall Street abstraction. That is your gas pump. That is your grocery bill. That is the shipping cost embedded in every product sitting on a store shelf. And here is the part that should actually concern you. That cost does not get absorbed by corporations out of goodwill. It gets passed through, into transportation costs, into food prices, into manufacturing inputs, into everything that touches energy, which is everything. Now layer that on top of an American consumer who is already carrying over $1.13 trillion in credit card debt, at average interest rates above 21%. You're not looking at a resilient system absorbing a temporary shock. You're looking at a system that has already been running without a buffer, now facing a $200 billion additional cost per year in energy alone. The pressure does not stay invisible for long. It shows up in earnings, in margins, in consumer spending data, and eventually in prices. The second force is rates. The Federal Reserve has held interest rates in a restrictive range between 5.25 and 5.5%. For months, the market was pricing in a series of rate cuts that would relieve some of that pressure. That expectation has been walking back steadily, and the bond market is reflecting it. The 10-year Treasury yield moved back toward 4.5% last week. That number matters, for a reason that most financial television glosses over. The 10-year yield is the foundation of the discount rate applied to future corporate earnings. When that rate rises, the present value of future earnings falls, which means equities, stocks, become worth less by pure mathematical calculation. This is not sentiment. It is not fear. It is arithmetic. And right now, the arithmetic is moving in the wrong direction for stock prices. The S&P 500 is still trading at a forward price-to-earnings ratio above 20. The long-term historical average is closer to 16. That gap between where valuations are and where they historically sit represents a significant buffer that can be erased if the rate environment stays elevated. And the higher rates stay, the more that gap closes. Not gradually, not smoothly. The kind of abrupt, uncomfortable moves that feel like they come out of nowhere but were completely visible in the data beforehand. The third force is liquidity. And this is the one almost nobody on financial television is explaining clearly, because it is the most misunderstood concept in modern markets. Liquidity is not simply cash in the system. Liquidity is the ability to transact, to buy or sell, without dramatically moving prices in the process. And that ability is deteriorating in ways that are not obvious from the headline numbers. Over the past several weeks, multiple large asset managers have quietly tightened redemption conditions across their private credit and real estate vehicles. Blackstone has faced billions in withdrawal requests across its real estate funds. These are not isolated stories. They are symptoms of the same underlying pressure. When investors cannot access liquidity in private markets, when the gates come down on their alternative investments, they do not simply accept the situation and wait. They create liquidity somewhere else. And the place where liquidity can always be created is public markets. You sell stocks, you sell bonds, you sell whatever you can turn into cash quickly. And what that means in practical terms is this: stress that originates in a $2 trillion private credit market, a market that most individual investors never directly touch, can become volatility in your retirement account within days. That is the transmission mechanism. That is how financial stress moves from the places you cannot see to the statement you open at the end of the month. Now take these three forces and stack them. Oil above 110 acting as a direct tax on the entire economy. Interest rates staying restrictive far longer than the market anticipated. And liquidity quietly tightening beneath the surface of the financial system in places that do not show up in the daily headlines. That combination alone would be worth paying close attention to. But there is a fourth layer, and it changes the character of the setup entirely. That layer is positioning. According to the latest Bank of America Global Fund Manager Survey, cash levels among institutional investors have risen sharply in recent months. That shift is significant because it is not just a number, it is a signal about intention. When the people managing hundreds of billions of dollars are raising cash, they are not doing it because they expect prices to go higher. They are doing it because they are preparing for the alternative. And preparation in financial markets always precedes movement. It does not follow it. By the time the movement is obvious, the preparation is already complete. Here is what makes Monday structurally different from a normal trading day. In a normal environment, these adjustments happen over time. A fund reduces exposure gradually across multiple sessions. A hedge fund rebalances intraday. A pension system shifts allocations over weeks. And the market absorbs the flow and prices adjust incrementally. This time, that process was interrupted. The information kept arriving. The data kept updating. The models kept recalculating. But the execution window was shut. So every adjustment that would have happened gradually across 2 days of trading is now sitting in a queue. And when that queue hits the market simultaneously, not sequentially, not gradually, but at the exact same moment, the result is not incremental adjustment. It is a spike. Think about what physically happens at the opening bell on Monday. Buy orders and sell orders that have been building for 48 hours flood the market at once. Algorithms that have recalibrated over the entire weekend deploy capital in milliseconds. Market makers, facing uncertainty about where prices should actually be, widen their bid-ask spreads to protect themselves from getting run over. Liquidity thins at exactly the moment when demand for execution is highest. And prices move fast, not because of panic, not because of a new headline, but because the market is doing what markets do. It is discovering where price actually belongs given everything that happened while it was offline. That process is mechanical. It is structural. And in the current environment, it is not going to be neutral. The underlying data is not neutral. Consumer spending data shows real wage growth has slowed. The personal savings rate remains near historic lows, meaning households have almost no cushion. Delinquencies on credit cards and auto loans are rising, not spiking yet, but moving in one direction consistently. These are not warning signals anymore. They are active pressures that are already inside the data. Corporate earnings expectations have started to adjust downward. Analysts at major banks have revised their forecasts to reflect slower revenue growth and higher input costs. Margins are being squeezed from both sides simultaneously. Revenue growth is decelerating while costs keep rising. That combination has a predictable outcome over time: lower earnings. And lower earnings, in a market that is still trading above its historical valuation average, require repricing. Not eventually, not theoretically, mechanically. The math demands it. I want to be direct about something before we go further. This is not a call for a single specific outcome. Markets do not move in straight lines. There will be rallies inside whatever comes next. There will be days that look like stabilization. There will be moments where the news cycle suggests the worst is over. But what those moments will not change is the underlying structure. And the underlying structure right now is shifting away from the environment that supported the rally of the past year. Falling inflation expectations, rate cut anticipation, stable energy costs. That environment is no longer intact. It has changed. And markets always reprice when the environment changes. The only open question is the speed. Monday is not the end of a process. It is the beginning of the repricing. It is the first moment the market has had to reconcile itself with a reality it has been unable to fully price for 48 hours. And when that reconciliation is forced into a compressed window, the result is rarely orderly. It is abrupt. It is fast. And by the time most people understand what is happening, the initial move has already completed. In part 2, I'm going to show you something more specific. Not just the forces building pressure, but the evidence of what the largest institutions in the world have already done in anticipation of this moment. Not what they are saying publicly, what their actual positioning data reveals privately. Because the gap between their public statements and their private positioning is one of the most telling signals available right now. And once you see it, Monday stops looking like an isolated event and starts looking like one step in a sequence that has played out before, multiple times, with a very recognizable pattern. There is a rule in markets that experienced participants learn, and most retail investors never do. Watch what institutions do, not what they say, because what they say is designed for public consumption. What they do is designed for survival, and right now, those two things are pointing in opposite directions. Let's start with the data that is hardest to spin. JP Morgan's prime brokerage desk, which processes positioning data from some of the largest hedge funds operating in global markets, showed that net equity exposure among those funds declined meaningfully over the past month. Understand what that means in concrete terms. These are not individual investors checking their Robinhood accounts. These are professional money managers operating with leverage, running sophisticated models, with teams of analysts and risk managers whose entire job is to get positioning right. When they reduce net exposure to equities, they are either cutting long positions, adding hedges, or both. Either way, the direction of their conviction is identical. They are reducing their bet that prices go higher. At the same time, Goldman Sachs reported one of the largest de-risking events among multi-strategy funds in recent years. A momentum unwind of that magnitude does not happen in a stable, healthy market environment. It happens when correlations shift unexpectedly, when the models that were working stop working, when the assumptions baked into systematic strategies break down and the funds running those strategies are forced to reduce exposure rapidly, regardless of whether they want to. This is a point worth pausing on, because it changes how you should think about large market moves. Most people watch prices fall and assume it is because investors got scared. Sometimes that is true. But increasingly, major market moves are not driven by fear or sentiment at all. They are driven by structure. A quant funds model flags elevated risk. The model does not hesitate, does not debate, does not wait for confirmation. It executes. It reduces exposure automatically. And when you have dozens of funds running models with similar underlying inputs, similar risk parameters, similar signal triggers, similar correlation assumptions, those executions become synchronized. One fund selling creates price movement. Price movement triggers the next fund's risk model. That fund sells. More price movement, more triggers, more selling. Small moves turn into large ones, not because sentiment collapsed, but because the mechanical plumbing of modern markets amplifies initial signals into cascades. That is the structure. And that structure is currently loaded and waiting. Now look at the options market, because the options market is one of the most honest signals available. Options traders are not journalists or analysts offering opinions. They are putting real money behind real probability assessments. The VX, the volatility index, the market's measure of expected daily price swings, has moved well above 30. For context, the long-term average sits near 14. When the VIX is above 30, options traders are collectively pricing in significantly larger daily price moves than normal. They are paying elevated premiums for protection. Insurance costs money in direct proportion to the probability of the event being insured against. When insurance against market downside becomes dramatically more expensive, it means the people pricing that insurance, who have access to institutional order flow and positioning data that most investors never see, have updated their probability assessment in a specific direction. That is not a signal to ignore. Credit markets add another layer, and credit markets matter because they tend to move before equity markets do. They are more sensitive to default risk, more responsive to changes in financial conditions, and historically more accurate as leading indicators than stock prices. Right now, spreads on high-yield corporate bonds, the difference in yield between risky corporate debt and safe government debt, have started to widen. Not dramatically yet, but directionally. And in the early stages of a shift in credit conditions, direction matters far more than level. Because widening spreads mean investors are demanding higher compensation to hold corporate risk. They are pricing in a higher probability of defaults, restructurings, missed payments. And that demand for higher compensation does not stay in the bond market. It feeds directly into the real economy through a specific, well-documented sequence. Companies that need to refinance existing debt do so at higher rates. Higher borrowing costs reduce investment. Reduced investment slows hiring. Slower hiring eventually becomes layoffs. Layoffs reduce consumer spending. Reduced consumer spending slows corporate revenue. Slower revenue puts more pressure on debt servicing. More pressure on debt servicing widens spreads further. The loop tightens. This is the sequence. It does not happen overnight, but it has started. And the early signals are already in the data. Bring all of this back to Monday morning. You have a market that is already seeing reduced institutional equity exposure. Elevated volatility expectations priced into options. Early stage widening in credit spreads. Oil above 110. Rates holding restrictive. Liquidity deteriorating in private markets. And 2 days of unprocessed information sitting in a queue that is about to open. What happens when all of that collides with a live market simultaneously is not complicated to model. It is a repricing event, not necessarily a crash, not a cliff, but a forced rapid adjustment that compresses into minutes what would normally take days. And rapid adjustment is where mistakes happen, where reactive decisions replace strategic ones, where investors who were not prepared end up selling into the bottom of a move that is already largely completed, while the institutions that positioned ahead of time, the ones whose data we just walked through, sit on the other side of those trades. Let's look at history, not to predict, but to recognize the pattern. October 1987. The Dow Jones drops 22% in a single day, Black Monday. The dominant narrative at the time was panic selling. The actual mechanism was portfolio insurance strategies, systematic model-driven selling programs that triggered automatically as prices fell, accelerating the decline, machines creating a cascade. Sound familiar? The narrative was Lehman Brothers. The actual mechanism started months earlier in the subprime credit market, spread through structured finance products that nobody fully understood, and by the time Lehman failed, the financial system had already been compromised at multiple levels for over a year, credit stress spreading to everything. March 2020, the fastest bear market in recorded history, a 34% decline in 33 days. The narrative was COVID fear. The actual mechanism was a sudden stop in economic activity combined with a simultaneous liquidity crunch as institutions rushed to raise cash. Everyone selling at once because everyone needed liquidity at once. 3 different triggers, 3 different eras, same underlying mechanism every time. Liquidity contracts, selling accelerates. Correlations converge toward one, meaning everything falls together because diversification stops working, and the move completes faster than most investors can respond. The current situation is not identical to any of those 3 events. The trigger is different. The specific instruments are different. The policy environment is different. But the early stage signals share structural similarities that are difficult to dismiss. Rising input costs pressuring margins, tight financial conditions with no easy release valve, shifting institutional positioning, and a market that is not yet fully adjusted to the new environment it is operating in. That last point is critical. The market is still, in certain key metrics, priced for the environment that existed before oil moved above 110, before rate cut expectations were revised downward, before private credit stress became visible. Prices reflect the old reality more than the new one. And the gap between where prices are and where the fundamentals now suggest they should be is exactly the gap that gets closed during repricing events. Now I want to address directly the objection that comes up every time analysis like this surfaces. The objection that says everything is probably fine, that the economy is resilient, that we have been here before and it worked out. And I want to give that objection the respect it deserves because it is not wrong to raise it. Markets have surprised people predicting doom many, many times. Resilience is real. Policy responses are real. The economy has absorbed significant shocks before. All of that is true. But here is what that objection misses. The question is not whether the system eventually recovers. It almost always does, eventually. The question is about the specific window we are in right now. And in this specific window, multiple leading indicators are pointing in the same direction simultaneously. Positioning is shifting. Credit is tightening. Liquidity is deteriorating. Energy costs are surging. Rate relief has been pushed further out. These are not one-off anomalies. They are a cluster. And when a cluster of leading indicators aligns directionally, the historical record is consistent about what follows. Not a certainty, not a guarantee, a probability distribution that has shifted away from the benign scenario. Markets move through phases: expansion, peak, contraction, recovery. The transitions between phases are where volatility concentrates. And the transition out of an expansion, especially one driven by specific catalysts that are now reversing, is not a clean, observable line. It looks like what we are seeing right now: elevated but not collapsing, stressed but not broken, moving but not yet directionally clear to most participants. That ambiguity is not a signal that nothing is happening. It is a signal that the phase transition is underway and is not yet completed. Monday is not the end of this process. It is a moment inside it. A moment where delayed reactions catch up to reality, where the positioning of the largest institutions in the world meets a live market for the first time after 48 hours of recalibration, where price discovers what it actually is rather than what it was when the market last closed. What happens next depends on how these forces evolve from here. If oil stays above 110, the pressure on consumer spending and corporate margins continues to compound. If rates hold at current levels through the next Fed cycle, valuation compression continues. If credit spreads widen from here, financial conditions tighten faster and the economic impact accelerates. Each of these factors feeds into the others. This is not a single variable system you can model in isolation. It is interconnected. And interconnected systems under simultaneous stress do not decompress gradually. They hold, and then they release. The Federal Reserve is constrained in a way that limits its ability to provide the relief it offered in previous stress episodes. Cutting rates aggressively risks reigniting inflation. Holding rates at current levels risks pushing the economy into contraction. That is not a comfortable position for the institution that functions as the ultimate backstop for financial stability. And when the backstop is constrained, the market has to absorb stress on its own, through prices, through volatility, through the kind of repricing that feels chaotic in real time but is entirely logical in retrospect. Monday morning, the bell rings. 2 days of accumulated decisions hit the market simultaneously. Algorithms execute. Market makers widen spreads. Prices move faster than the headlines can track. And within the first 30 minutes of trading, the character of the week, and potentially the next several months, begins to take shape. Most people will watch the numbers move and reach for an explanation after the fact. They will find one. They always do. But the explanation will miss the mechanism, and the mechanism is what actually matters. Because once you understand the mechanism, you stop being surprised by the outcome. You start recognizing the sequence as it develops rather than after it completes. You see the positioning data and understand what it means. You see the credit spreads and understand what they are signaling. You see the oil price and translate it into economic pressure before that pressure shows up in earnings reports 3 months later. That is the difference between reacting and being positioned. And right now, the window to understand what is happening before it fully develops is still open. Not for long, but it is open. Pay attention to Monday morning, not with fear, not with panic, with a specific kind of focused awareness that comes from understanding exactly what is about to be expressed and why it built up the way it did while the market was sitting silent, waiting for the bell.